Assume that if everyone can see my presentation. So, welcome to our financial accounting class, and this is our first class actually for this financial accounting. Now, topic one is called the introduction to financial accounting, and in topic one, okay, thank you. Someone has responded from the chat box. So as I was saying, that this is the first class of the financial accounting, and the first topic is introduction to financial accounting. We shall just be talking about some items, which is the theory part of this unit. So today we are not going to do any computation. So when we talk about financial accounting, we need to start from the word accounting. So what is accounting? And when we talk about accounting, we need to understand the nature of the accounting, and also we need to understand purpose of accounting. Now, accounting, from the definition you can see from my screen, it is a process which involve, number one, to identify. So you identify, you measure, you record, and then you summarize the financial transaction and events. That is the main. So the keyword here is we are trying to identify, then measure, then summarize what? The financial transaction and events only. Then we present those information and interpret them so as to come up with a financial statement. So we have two definition. We have two parts. The part number one for accounting is the process of identifying, measuring and recording and summarizing the financial transaction and events. And then the second part is we present and interpret that information through a financial statement. So a financial statement is a structured report that is prepared by an accountant. So as to do what? So as to allow the users of this information to do what? To make informed decision. That is very correct. But if you define your report up to this part, up to the financial statement, it will also be correct. The structured process of identifying, measuring, recording, and summarizing the entity financial transactions and events, and then presenting those information and interpreting them through financial statement is correct up to that point. Now, financial transactions, these are the normal transactions that it is done daily. For example, sales, payments, payment of salary, all those are form of transactions and events. For example, if you buy an asset or you sell an asset, you buy a vehicle for the business, all those are categorized as financial transactions and events. Now, when we talk about the nature of accounting, number one, it must be a process from the definition. It must be a process. Now, a process which number one, we identify the transaction. For example, an example of a transaction is making a payment or paying for a particular item. Number two, that item must be measured in terms of money. So it must be in a monetary form. For example, if you pay for books, now that book can be converted into money, and then we record them using the double entry system. That is, for every debit there must be a credit. Then we classify them into ledgers. So we classify them. Now that is the ledger. So the ledger is a books of account which records the transaction. Once we record them, we summarize. Once we summarize them, so we summarize them by coming up with a trial balance. That one is fine. Then we report them using the financial statement. That is from our definition. So we identify the transaction, we measure them, we record them, then we classify them. So for example, or how do we classify the transaction? So if it's an asset, we put it under asset. If it is an expense, we classify it as an expense. If it's a liability, we classify them as a liability. If it is a what? An equity item, we classify them as an equity item, and so on. So the purpose of coming up with a ledger is to make sure that each transaction is recorded in the correct ledger account. So for example, if it's a motor vehicle, you classify all the items of motor vehicle in one account. If it is debtors, you record every item concerning debtors into one account. That is classification. Then we summarize them. So once we classify, then we can come up with a trial balance so that we summarize and then we report them. Number 2, quantitative and monetary. The transaction should be in form of can be measured. It can be measured in terms of money. That is number 1. So the transaction and events that we were talking about in our first definition of accounting, that transaction or event can be measured reliably in form of money. Higher. Number 3, another nature. So in an example, you talk about the nature of accounting. This is what you talk about these items. Number 3, it's a principle, and it is based on principle and standards, i.e., there are rules and regulation that must be followed. There are rules and regulation that must be followed. For example, the IFRS and IAS that is used to prepare the financial statement, those conceptual frameworks that are there. So that it is based on principle and standards. And then another nature of accounting, it is that it is historical in nature. It uses the historical information or past records to predict or to present the information. So it uses the historical information to prepare the financial statement. It uses the historical information to prepare the financial statement. Number next, another nature of accounting, it supports stewardship. It is support stewardship. Now, when we talk about stewardship, we are talking about how management utilizes the financial resources entrusted to them by the owner of the business. So remember, there is a difference between the owner and the management. The owner, they are too busy to work. So the owners are too busy to work, and therefore they cannot manage the business, and therefore they entrust the managers to work on their behalf. And therefore the management should do what? Should support what we call stewardship. That is to make sure that the resources of the owners are well safeguarded, well utilized, there is no embezzlement and such a thing. Also, that one forms the nature of accounting. And then another nature of accounting is both an art and is also a science. So in simple term, an art is a form of judgment. So you can make a judgment as an accountant that we shall do this. For example, we shall come up with a provincial of provincial for bad debt, and maybe we shall say it will be 10%. That is a judgment. It's also a science because it uses computation. For example, we shall be doing computation. So that one is a science. So we said that accounting, under accounting, we shall look on two things. That is the nature and the purpose. Now, for purpose, we have various purpose, but we have the 3 important purpose that you need to know. The first 3 that you can see there. So, purpose of accounting. Why is it important, or what is the uses of accounting? Now, accounting is useful to produce. So, purpose of accounting is to produce useful information for the purpose of accountability and for the purpose of making decision. Now, the following are purpose of accounting. Number one, it measures performance. It measures performance. How do you measure performance? By looking at profits. So that's number one. So you go to the income statement, then you look at the profit. If the profit is positive, then we can say that the performance is good. If profit is negative, we can say that they had a loss during that year. So number one, it is there to measure performance. Now this one is through the income statement. You can just add here through the income statement. So through the income statement. So the income statement is the one. The income statement or the P&L statement or the profit and loss account. Profit and loss. Trading, in fact, it's supposed to be trading profit and loss. You can also look at the revenue. You can compare the revenue for that period with the previous period. If the revenue increases, then you can say there is a good performance. If the revenue decreases, then you can say that there was a decrease in revenue. Number two, it shows the financial position, and this one is through the balance sheet. So this is supposed to be through the balance sheet. So how do you measure financial performance? By looking at the balance sheet. Balance sheet or the statement. They also call it statement of financial position. I will share these notes. Don't worry. Statement of financial position. Now we can look at our assets, our liability, our equity, and so on. So through that, we can tell how did the firm perform during a particular period. So number two, the main purpose of accounting number two is it shows the financial performance. Sorry, financial position, not performance. Performance is number one. Financial position of a company, and that is achieved through looking at the balance sheet or the statement of financial position. Number three, it tracks cash flow. It tracks cash flow by so this one is achieved. So this one is achieved through what? By looking at the cash flow statement. So through the cash flow statement, Now, when we look at our income statement, when we look at our cash flow statement, we can easily tell how we used our cash or our money in the bank. So either cash or cash in bank, cash at hand or cash which is in the bank. So our cash flow will tell us how much did we receive during that period and how much did we spend in that period. So it shows the cash generated and used in a particular period. So it shows the cash generated and the cash used during a particular period. And this one we shall utilize the operating, investment, and financial activity when we shall be doing the cash flow statement. So for now we state it. And then so this one are the main ones. So in an exam, these are the main function of accounting, which is also the function or the purpose of financial accounting. So if they tell you to state the purpose of the financial accounting, it is the same as the purpose of accounting for the first three. Then you have other purposes. Other purposes, it assists in recording and summarizing of the financial transaction or the business transaction. Business supposed to be business, financial. Supposed to be financial because it must be in money form. So it assists in recording and summarizing of the business financial transaction accurately and in a systematic manner. Number 5, another purpose, which is not our main idea, but it is also one of the purpose, it supports decision making. So it helps the users. So remember, when we are talking about accounting, in this case, we'll be talking about the user. So it assists the users of this information to decide whether to lend money to that company, or to be a supplier of that company, or to assist the company to raise funds for expansion purposes. All those relates to the user. And then number 6, we have talked about accountability, that is stewardship. So another purpose of accounting is to make sure that the management uses the resources entrusted to them by the owners effectively. So that is stewardship. So another purpose of accounting is to ensure that the management uses the resources, and especially the financial resources entrusted to them is well utilized for the purpose of the business, only. Another aspect or purpose of accounting is to support compliance. So to ensure that the company complies with the government, for example, payment of taxes, what else? To make sure that they support the community, all those kind of things. So it helps the organization or the company to meet the legal and the regulatory requirement. And for example, you have said payment of taxes, to make sure that the company does or do the audit as prescribed by the Company Act, and so on. Number 8, it enables comparison. So performance. So if you can measure performance as a business across the time period, or across the financial period, then you can compare that performance with that of another business. So it allows comparison of financial transaction between one company to another. Now let us see what is financial accounting now. So since we have talked about accounting, then now it will be good if now we talk about financial accounting. Now financial accounting is the process of recording, classifying, summarizing, and reporting an entity financial transaction through a general purpose financial statement in order to permit informed judgment and decision by the users. Up to this point, it's okay. The keyword here is the users. So your definition must have the word users. If the term users is not there, then your definition will be incomplete. Now, once we do what? Once we record all the information, we classify, and then we summarize, and then we present. So we present stroke report. So when you talk about reporting, it's the same as saying presenting. So reporting and presenting is the same. So reporting an entity or presenting an entity financial transaction in form of financial statement. So in form of a financial statement in order to permit informed judgment by the users of this information. Who are those users? The investors, the lenders, the government, and then the stakeholders. So and then remember, the main use of this information is the owner. So the owners, investors stroke the owner. So remember, the owner is the main. Let me use the word owner. I prefer the owner rather than investor. So the owner has invested in that business, and therefore he will need this information as to make decision on whether the company is making any progress. So the owner relies to the financial accounting or the accountant. So the accountant does what? Record, then classify, then summarize, then present the financial transaction in form of a statement so as to allow the users of this information to make what is called the informed decision or judgment. So make sure if they ask you to define financial accounting, the part of informed decision, the part of informed decision and users are there. Now that's the objective. We said the first three objectives are common. Look at this objective. Number one is about financial performance. So the first objective of financial accounting is to provide the information about the financial performance of the company. And how do we achieve it? By looking at the income statement. So we check our revenue or our sales. Revenue, another name of revenue, you can use sales. So revenue and sales go hand in hand. So we can check our sales. Did our sales increased or decreased during the previous period? So for example, if our revenue iliongezeka, then we can say that is a good financial performance. If our revenue did not increase, then we can say performance maybe was not good. Then we can also check our expenses. Now, how much was our expense this year? We compare it with last year expenses. Now, expenses should reduce. So if my expenses reduced from one year to another, then the performance is good because the cost it may reduce. But if our expenses keep on increasing from one period to another, so in another increase, then we can say that we do not have we do not have clear policy on how to handle cost, and therefore that one could be an indication of a poor financial performance. We can also check on our profit. So if we made profit, it can be an indicator of a good financial performance. If we made losses, it can be an indicator of a poor financial performance. Number two, it provides information about financial position. So it provides information about financial position. And that one we said we look at our balance sheet. So we check the assets, the liability, and equity for that company. So if our asset is increasing from time to time, and that asset is used to generate sales, then we can say that those assets indicate a good financial position. If our assets are dormant or they are not used to generate, so the assets are not in use, or we have assets but the assets cannot generate any form of income, then we can say that it indicates what we call the poor financial position. Poor financial position. Then number three, the next objective is it provides information about the cash flows. It provides the information about the cash flows. Now, cash flows means we are checking money in and money out during a particular period or a particular financial year. So another objective of accounting is to provide information about cash flow by explaining how cash is generated and how cash is used in operating, investment, and financial activities. And that one we shall look at it when we shall be talking about cash flow statement. Then other objective, we have the stewardship part. That one is for accountability, to make sure that the management uses the resources entrusted to them effectively and responsibly. And then number five, another objective is that financial accounting also permits the informed judgment and decision so as to allow the users, the keyword here is the word users, to make decision, to make sound and economic decisions. Good. Let us see the element. Now, element of the financial statement. Now, we have the asset, we have the liability, we have the equity, we have income, and we have expenses. Now, the first three, they are element of the financial statement in the balance sheet. And then the last two, these are the element of the financial statement in the income statement. Now, an asset is a resource which is controlled by an entity as a result of past event from which we expect a future economic benefit. So that's a good definition of an asset. For example, an inventory. So an inventory is controlled by the management. The assets, if you have an equipment or a motor vehicle belongs to the company. So it is controlled by the company as a result of past event. Past event means you bought it in the past. So you cannot claim that you have an asset and then you claim that you are going to purchase it in the future. No. So for an asset, for something to be an asset, you must have it, or maybe you did a transaction during the past. So you cannot say that you have a computer which you expect to buy it in the future or to buy it tomorrow. You must have bought it during the past period, yesterday or the day before. So an asset is any form of resource which is controlled by an entity as a result of past event. Past event is we bought it in the past, and which we expect some future benefit from that asset. Which benefits do we expect from an asset? For example, if we have a motor vehicle as an asset, we can use that motor vehicle to carry goods. Now, the money that we get from carrying those goods is a benefit to us. And that is what we call the future economic benefit. If it is an inventory we can sell it in the future, then we get money. That money is what we call the future economic benefit. Number two, we have a liability. A liability is a present obligation. It must be a present obligation, but because of past event. For example, ulienda ukachukua loan jana for example ya 20,000. Now that 20,000 today is a present of, you need to pay. So there is something that you need to pay. So ulikopa jana 20. Now ukikopa jana 20, leo hiyo 20 bado iko. So it must be a present obligation but from past event. Past event means what? You borrowed that money yesterday or in the past period. So it must be it must be a present obligation arising from past event of which the settlement is expected to lead to what? To an outflow of the resources. So remember for asset, we expect a future economic benefit to flow to the entity. So that's an inflow. So this one, number one, hii ya kwanza ni inflow. So an asset, we expect an inflow. But for liability, we expect an outflow. Kwa sababu pesa itakuwa inatoka. Kama uko na deni, ukilipa hiyo deni, pesa inatoka kwa akaunti yako ikienda. So hiyo pesa ikitoka, that represent an outflow of that resource. So it is a present obligation as a result of past event from which the settlement would lead to an outflow of the economic resources. Then we have equity. Now equity refers to a residue interest in the asset of an entity after deducting all the liabilities. So remember, you need to deduct all the liabilities so that you can get the equity. So that one means it is the amount of money which belongs to the owners. So the keyword here is the word owners or the investors. So it is the amount of money which belongs to the owners or the investors. Then you have the revenue and the gains. Now revenue and gains. So income increases in the economic benefit during the period in form of an inflow or enhancement of an asset, or decrease of liability that results in increase in equity other than the owner's contribution. So when we talk about income, which is form of revenue and gain, we exclude the owner's contribution. So income increase in economic benefit during the period in form of an inflow or enhancement of asset. Up to that point, this one could be a good definition of an income. This one. We can use that one. We ignore the other one. What does it mean? For example, if we have an asset, let us assume we have an asset. For example, we have a machine that is used in production. So that machine that is used in production, it produces number of units, or it produces items or products. When we sell those products to the customers, those products is what we call the income. The money, sorry, when we sell those products and we exchange those products in exchange for money from the customer, that money is what we call the income. So income increases in economic benefit during the period in the form of an inflow. Inflow means money in, or enhancement of an asset is what we call an income. Then an expense is a decrease. So up is supposed to be this one is supposed to be is an increase. Income is an increase in economic benefit. So there was a problem with that part. It's supposed to be income is an increase in economic benefit during a particular period or from the enhancement of an asset. For example, a machine. You can use a machine to generate that income. Then an expense refers to a decrease in economic benefit during a period in the form of outflow or reduction in asset. Up to that point, that would be a very good definition. The rest you can remove. The rest you can do away with. So look at that. A decrease in economic, for example, when you pay a rent as a business, that's a decrease in economic benefit. That is a decrease in form of money. So kama ulikuwa na 20,000 ukalipa rent ya 10,000, umebaki na 10. So it may reduce from 20 to 10. So that 20 to 10 is a decrease in economic benefit. For the income, we said it is an increase in economic benefit. Let's assume that you had 20,000 in your account. Then you ukauza some product. When you sell those products, the customer will pay you. So maybe ilikuwa 20, it can increase to 30. So that increase is what we call an increase in economic benefit during a particular period, and that one represents an income. That represents an income. That is correct. That's the accounting equation. Accounting equation. Now, accounting equation states that assets must be equal to liability plus equity. Now, the accounting equation is a fundamental. So, in an exam, they can tell you to define what is an accounting equation. Then you shall say, it's a fundamental rule in accounting which states that all items, comma, a business total assets are equal to the total liabilities and equity. That one is okay up to that point. So, an accounting equation is a fundamental rule in accounting which states that all assets must be equal to equity and liabilities, must be equal to equities and liability. And we have the equation there, you can see. Basic accounting equation, that is the basic one. Where the asset we say, this is a resource. This is a resource which is controlled by the business as a result of past event and which we expect some benefit from it. Then liability we said is a present obligation as a result of past event where the settlement is expected to do what? To reduce the economic benefit. Then you have equity. We say that is the owners, the amount of money remaining for the owners of the business after doing what? After paying all the liabilities. Now let's see the expanded accounting equation. Expanded accounting equation. So expanded one says asset is equals to capital plus liability plus income minus expense minus drawing. Now this one means retained earnings. You can just say where. Let me just put it on the other side. We can say we can talk about retained earnings. Just a moment. Retained earnings. That means income minus expense. Now, this is the expanded equation. Asset is equals to capital plus liability plus income minus expense minus drawings, where capital is the owner's amount or owner's investment. Number two is the income, and you said income is the increase in the economic benefit. Then you have expense, which you said is the reduction in the economic benefit. Then we have drawings. Drawings can be in form of money or goods. That one we shall talk about it later. For drawings, we shall talk about it later, because that is when a person maybe took some money from the business for personal use, or goods from the business for personal use. Then we have the retained earnings, which represent income minus expenses. That one we shall the last two we shall talk about it later in detail. So for now, you just know that one. That drawings can either be in form of goods. So you withdraw money from the business for personal use, or you took some goods from the business for personal use. Now, why is it equation important? Now, before even we continue, we need to notice somewhere. NB, we say the equation uses the double entry system rule. The double entry system rule. What does it mean? System inaandikwa vipi? System rule, i.e. So i.e. for every debit there must be a corresponding credit. That is correct. Now we shall talk about these items later. For now, we just set them, so you just understand by stating them. Now let us see, why is it important. Number one, it is a foundation of double entry. That is number one. So this accounting equation is important, number one, because it forms the basic foundation of double entry bookkeeping, and that is every transaction has two effects. Two effect means debit and credit. Number two, this accounting equation ensures accuracy in recording. So it ensures accuracy in recording by making sure that the account balances. So it is this equation that makes sure that the account balances. And then number three, it links directly to the statement of the financial position. That is very good. This equation is important because it links directly to the statement of the financial position, which is built from asset, liabilities, and equity. You can also add that it also links directly to the statement of the financial performance. That one is correct. That one is, up to that point is fine. Statement of financial performance. So it links directly to the statement of financial performance. That one is fine. Let us see some of the effects of the common transaction. Number one. So make sure you know this. This one is important. This part. This one is very, very important. This one I will emphasize. Number one, if an owner invests cash into the business. Now, how do you record this kind of a transaction where the owner ameleta pesa kwa business? So yeye ametoa tu pesa, hata julikani ametoa hiyo pesa wapi, akaileta kwa business. Now, kama ni pesa imeletwa kwa business, number one, you record it as a cash. So the cash will increase. So you record it into the cash account or the bank account by increasing the cash. Number two, because ni owner ameleta hiyo pesa, it will increase the capital account or the equity. So equity or capital, whichever. So equity or capital. Capital, remember we said capital, it is the money which belongs to the owner of the business or the equity. We say equity is the money which remains when we less all the liability. So equity represents the owner's fund, and therefore when we bring money to the business, we shall increase the equity account, and also we shall increase the cash because the cash is also increasing. Number two, when we purchase an inventory for cash. So when we purchase an inventory in kumaanisha our inventory will increase. So we increase the asset, but our cash, so tunalipa through cash. So cash ina reduce, so we decrease our cash. What happened when we purchase an asset on credit? When we purchase an asset on credit, now asset itakuja kumaanisha asset will increase because we are, hata kama tunanunua on credit, that asset itakuja kwa business hata kama tumenunua on credit hatujalipa. So kumbuka kule hatujalipa, lakini asset tumenunua imefika kwa business, so we increase the asset. But remember when we purchase on credit, tuna increase madeni zetu kwa sababu hatukulipa ukule. So kumaanisha tuko na deni, so deni yetu ime increase, so we close our debtors because hawajatulipa. So wakitulipa ndio tuta reduce. So we are going to do what? We are confirm. Okay, I'm assuming that you can see. Now when we make access on credit, we increase our debtors kwa sababu hawajatulipa. So deni imeongezeka kwa our debtors. So we increase it. And then we do what? We increase our equity. Equity will increase. But why are we saying that our equity increases? Remember, equity for the profit is part of equity. So remember, profit is part of equity. So equity increases through the income or through the profit. But remember to just receive it directly. We shall do a question concerning that one later. Then pay an expense in form of a cash. So ukilipa an expense, your cash it'll do what? It'll reduce kwa sababu unalipa. Then remember, expense will do what? Will also reduce, or equity will decrease through the expense. Then owners withdraw cash. So when one withdraw cash for personal use, cash will reduce, and then equity will do what? Equity will decrease. Now you just write it down. We shall do a question concerning that one for now. Now let us see the users of the accounting information. So we have two types of users. We have the internal and we have the external users. Internal users is the management and the employees. So management and employees, and also trade unions. Now users. So users number one, let's start with the internal. So management. So why would management want this information about financial accounting? Why would they want this information? Now they would want the accounting information for the purpose of doing what? Planning, controlling, and making decisions such as budgeting, setting prices, evaluating performance, etc. So they would want this information for those kind of reasons. Number two, employees and trade unions. Why would the employee want to know this accounting information? Number one, for the purpose of assessing the job security. So will this company be able to sustain me for the next 10 years? Ama hii kampuni iko hapa for the next 2 years ifungwe. So you want to see the performance of the business so as to assess the security of that business, so that you can assess if it is secure in terms of job opportunities. Number two, the trade unions might want to know this information so as to negotiate for payment of salaries or increase of salaries and so on. Then you have the external users. Number one is the owners or the shareholders. The owners. So why would the owner want this information? So number one, to know if the business is performing well in terms of profits, growth, or in terms of performance. So profitability, performance, growth, and so on. Number two, lenders. Why would lenders want this information? Now they want to know the account information to know if the company is able to pay loans together with the interest. Number two, they want to know if the company has enough assets for what? For taking loans. So before a company secures a loan from a bank, they need to do what? To attach a security or a collateral. So that collateral can be an asset. So the lenders will want to know if this company have enough assets with them. Number three, suppliers. Why would suppliers want this accounting information? Number two is for them to do what? To know if they can try to the business to supply goods in the future, and if they supply goods, will the company pay them back in due time? Because most of the suppliers usually supplies goods on credit. Most of the companies do not pay the suppliers in time. They usually take maybe around 2 months, 3 months to pay them back after they have supplied the goods. Now the suppliers will want to know if we supply goods to that company on credit, will they pay us in time? So they need to assess the financial information of that company. Then the government. So the government would want to assess the accounting information of this company so as to assess how much in form of tax this company should pay. So that is the only thing mostly. So the government or the tax authority would want to see the accounting information of that company in order to assess the amount of tax liability, or if the company is complying with the tax laws and regulation. And mostly this is for tax payment and assessment. Customers. Why would customers want this information? Now, they use the accounting information, especially when they depend on the business for long-term supply, to assess whether the company is financially stable enough to continue operating. So remember, customers are the key stakeholders for the business, and therefore they would want to know, can we write to this company for long-term supply or for long-term So if the company will be there for a very long time, so they need to keep on assessing that. Number F, regulator and industry bodies. So they want this information for the purpose of doing what? For setting reporting standards and legal requirements. So they will want this information mostly to set and to ensure that there is compliance with the reporting standards and legal requirement. And then you have the general public community. So they want this information to ensure that the company also engage in local development, they safeguard the environment, and they also ensure what we call the corporate social responsibility. For example, payment for fees to these vulnerable people within the community, and so on. So that is the general public. So those are the users. So tunataka tuharakishe so that because ni theory tumalize haraka. Let's see the branches of accounting. We have number 1, bookkeeping. Now bookkeeping is the same as accounting, but bookkeeping is the beginning, accounting is the end. So you need to know that. We talk about bookkeeping is the beginning of everything. Then accounting is the end of everything. So what is bookkeeping? Bookkeeping is the systematic recording of the business transaction in the books of account. Hadi hapo tuko sawa. Unaweza achia hapo. So systematic recording of transaction in the books of account. Hii the monetary term acha tutoe because we know it must be monetary. We can remove it. So refers to the systematic recording of business transaction in the books of the account. Good. Now, what is financial accounting? We have said is the process of recording, classifying, summarizing, reporting, or presenting business transaction and events in form of a financial statement, so as to do what? So as to allow the users to make informed judgment or decision. Informed judgment or decision. That one we did said. So that one hatukai hapo sana. So the word decision must be there. Decision and what? Informed judgment and users. So we have the user here, both internal and external users. So that information allows the internal and external users to make informed judgment and decision. Judgment and decision. Good. Now, cost accounting. What is cost accounting? Now, cost accounting, we are just going to state it. It is not relevant here. But cost accounting is the process of controlling cost. That is all. So when we talk about the process of controlling cost internally, that is what we mean by cost accounting. So the process of ascertaining and controlling cost internally is what we call the cost accounting. So hapo anasema cost accounting is the branch that ascertains and analyzes. Here the word analyze, you can remove the word analyze and say control. Control cost. Up that point, that one is okay. What about management accounting? Now, management accounting is a broader field of cost accounting. So cost accounting, then we go to management accounting. So cost accounting analyzes and ascertains cost or control cost. Then management accounting uses that information to make decision. That is all. So management accounting uses the financial and cost information to help management in making decision. Hiyo cha tuikate kwa kidogo. Making decisions. Making decisions. That one is correct. Decisions. Hii nimeandika vipi? Decisions. That is correct. Now, management accounting refers to the Hapo wanatu confuse. This one. Management accounting is the process of ascertaining and we'll use the word ascertaining is a process of ascertaining and controlling supposed to be controlling costs to help the management with decision making. Hii nimeandika vitu zangu, decision making process, process. That is a good definition of management accounting. So that's what it's all. So remember, management accounting relies to cost accounting. So cost accounting analyzes the information and ascertaining the information about cost. Then the management accounting uses those information that has been analyzed by the cost accountant to make decision. Now let us see public sector accounting. Now public sector accounting refers to the accounting services carried out at the local, state or federal governments or ministries and parastatus. Government ministries and parastatus. So that means when we talk about public sector accounting, refers to the accounting which is done in the public sector or which is done within the government. So this is the accounting services carried out within the government. So accounting services carried out within the government. Then you have the auditing. Auditing is an independent examination of the books of account to make sure that they are free and fair. So that is all. So auditing is an independent examination of books of the account to make sure that the information presented is free, so it is fair, it is true and fair. So it is true and fair. So an independent examination of books of account to ensure that the information provided is true and fair. Let us see the difference between bookkeeping and accounting. Number one, So let us see the differences. So difference number one. So we're talking about the difference between bookkeeping and accounting. Number one, bookkeeping is there to do what? To record information. So that is the primary stage. It is there to do what? To record transaction. Now accountancy is a broader system. It's a broader system that uses the records to prepare reports or the statements, to prepare reports and interpret results. So the reports here is the statements. So remember, this one is the financial statements. Let's go to number two. So tumesema number one is bookkeeping. It is there to do what? To record transaction as a primary stage, to insert those information into the books of the account, just to record. Books of account, the most important item for them is to record. Now, but from the part of analyzing, classifying, then that one is accountancy. So the accountancy is a broader system that is used to do what? To record also, then to do what? To summarize and to prepare the financial statement, and then to interpret the results. Number two, nature. Now, bookkeeping is a routine. Bookkeeping is a routine and mechanical work. We do it every day, every time, day to day. The recording is done every day, every time. Whenever a customer comes, we record. Whenever we do a sale or we sell something or we pay something, we record. It's a routine. So bookkeeping is a day-to-day routine. We do it every day. Now, accountancy, it's an analytical and a judgmental based work. So it is based on what? It is based on the routine work. So accountancy deals with the judgment. Number three, stages. Bookkeeping is it's the initial stage, while accountancy, it is a later stage. So later stage by the later item. So when we record, that is the initial stage. When we record, that one means initial stage. But for later stage, it is when we have all those recorded items, then we start doing what? Summarizing, reporting, interpreting, and so on. Output. What is the output of bookkeeping? Now, the output of bookkeeping is the journal, the ledger, the cash book. Those are the output or the final product. Now, the final product of accountancy is the trial balance, the financial statement, the analysis, and the interpretation. That is, for example, ratio. Analysis and interpretation of ratios, for example. All those, you can say into bracket. Analysis, you can say into bracket, ratio analysis, a good example. So that you sishangae what analysis. So we can say ratio analysis. Principle. Now, the principle of bookkeeping is double entry system, while the principle of accountancy is the double entry, while the principle of accountancy is the IAS and the IFRS. Purpose. Now, the purpose of bookkeeping is to do what? To record data. This one is supposed to not to create. This one is wrong. To record data. To record data and do what? So that is the purpose. So the purpose of bookkeeping is to record data, while the purpose of accountancy is to convert the data into meaningful information for decision making. That one is good. I will share the notes, so msijali, we shall write it. Let's see the difference between financial accounting and management accounting. Number one, financial accounting is an internal and external affairs of the users, while management accounting is an internal affairs of the management. So this one can say supports internal affairs. This is supposed to be affairs of entity, i.e., you can say i.e. decision making, i.e. decision making. So that's number one. So you need to remember that financial accounting is both an internal and external affairs. So it provides financial statement for external and internal affairs of the users, while management accounting support the internal affairs of the entity. Number two, users. Now, the users of financial accounting, these are the shareholders, the lender, the government, the management, creditors, suppliers, all those are the users for financial accounting. But for management accounting, the users are only the management. So the users are only the management internally. Regulation. Now, financial accounting is regulated by the standards, for example, IFRS and the General Accepted Accounting Principle stroke IAS, International Accounting Standards. International Accounting Standards. So regulation. So financial accounting is regulated by International Financial Reporting Standards, General Accepted Accounting Principle, and International Accounting Standards. For management accounting, there is no general rule. So for management accounting, there is no general rule to follow. There is no. Time focus. Now, financial accounting focuses on historical information, while management accounting is a future-oriented accounting. So, financial accounting uses historical information, and then management accounting is a future-oriented for kind of an accounting type of information. Now, financial accounting mostly the information is monetary and objective. For management accounting, the information is both monetary and non-monetary. Reporting. Financial accounting, they do reporting periodically, maybe semi-annually, quarterly, or it depends. So for financial accounting, the reporting frequency is on a periodic basis, that is on annual basis, on semi-annually basis, or in a quarterly basis. Now, for management accounting, the reporting is daily. You need to report it on a daily basis to the management. So the reporting is daily. Let's go to the next item, auditing. Now, for financial accounting, auditing is a requirement. So it is a requirement to do an audit for financial accounting. Management accounting, auditing is not a requirement. So you are not required to do any form of auditing unless you just want to do it, but it is not a requirement. Level of detail. Now, for financial accounting, it provides information about the business overall. It's an overall business result. Now, for management accounting, it provides information on basis of department or project or a center. So it is not for the business as a whole. So, for example, finance department, they can provide the information, yet the procurement department has not provided the information. But for financial accounting, it combines all the departments together to form one result. So it is for the business as a whole for financial accounting, while for management accounting, it is only for the business. It is only for the business. It is only for the department, sorry. or project or the center. Now, let us see the difference between financial accounting and cost accounting, which is the same as the one for management accounting. So this one, I think it's not a requirement. We can give this one stroke. I can just say stroke management accounting. Management accounting. Management accounting. And then ile huko juu you can say stroke. So you can use any. Hii tumefanya hapa juu you can say stroke. This one you can say stroke cost accounting. You can say stroke cost accounting. Haya. I think that one is fine. Haya, hiyo nitaachia tu vile ilivyo. Bas. Haya, so I'm going to skip this one. Difference between financial accounting and cost accounting, because it is the same thing. It is the same thing. I don't have to repeat. Let us see the accounting cycle or steps. Now, an accounting cycle is a repeated sequence of steps that is used to record transaction and produce the financial statement. So unaanza from recording up to the final part, that is producing the financial statement. So ukimaliza tena unaanza upya, you start now again from the recording. So it is a cycle. So let's see the cycle. Number one, we record the transaction in our source documents or the ledgers. Number two, we come up with the journal entries in a chronological manner or recordings. Then we post it to the ledgers. So for the ledgers, this part of ledger number 3 is where we do classification. So we classify assets as assets, expense as expenses. Then once we prepare the ledgers, then we generate the trial balance. Once we prepare the trial balance, then we do the adjustments. For example, kama kulikuwa na any accruals, prepayments, depreciation, we do all those adjustments. So I know you know those adjustments, even from financial accounting that you have done maybe in school. We do adjustment, then we come up, once we do the adjustments, we come up with an adjusted trial balance. Then we close those entries, then we transfer those items from the trial balance to prepare the final financial statements. Once we complete, then we go back to the first step, that is the recording of transaction. So this process is a repetitive process in that manner. Now, type of accounting information. So we have the financial position information. That is the information about the balance sheet or the statement of financial position. That one is correct. But assets and liability. Number two, we have financial performance information. That is, we get it from the income statement or profit and loss. So that is the things to do with revenue, expenses, profits, and so on. Then you have the information, cash flow information. That is the information from the cash flow. For example, money in and money out, the expenditure, disposal, and so on. Then you have the cost information. This is information about cost of a product. For example, a product, we produce a particular product which the cost of that product maybe was 10 shillings per unit, and so on. Then you have the planning and controlling information. That is the information about the budget of the business, the performance report. Then the last one, which is very important, that is the social corporate responsibility. So the information about social, environmental, and human resource accounting information. Now that is the impact of the impact of the business in the environment, the impact of the business to people, and then the human resource accounting information. So the information about the human resource from the business perspective. That one is correct. That one is well said. I think it is correct. Now we have the definition of the financial statement. So what is a financial statement? Now, financial statement is a formal structured report prepared from the accounting records that presents the entity financial performance, position, and cash flow for a period to help the users to make the informed decision. So performance, remember we said is the income statement. So that one is the income statement. The income statement. And then this one is the balance sheet. And remember, these are the financial statements. So we have different type of financial statements. So we have the income statement, the balance sheet, and the cash flow statement. Now we can also say cash flows statements. So this is a structured report that is prepared from the accounting records, which presents the financial position, financial performance, and changes. And changes. So this one I need to say and changes in cash movement. Cash movement. And that is the cash flow statement now. To bracket the cash flow statement for a period, so as to help the users of this information to make informed economic decision. Now, these are the examples of the financial statement. So the first three terms they highlight Pareju. The first three, that is the statement of the financial position, then the statement of the financial position, statement of profit and loss, that is the income statement, then the statement of cash flow, and then we have others. So we have the others. So we have the statement of changes in equity and the notes of the account. So wakikuuliza kwa mtihani, give any 5 forms of the financial statement. Give any 5 form of the financial statement. Number 1 utasema financial statement of the financial position, statement of profit and loss, statement of cash flow, statement of changes in equity, and the notes to the account. Now objectives tumeshasema, I think hii sitarudia. Number 1, the objective of the financial statement is the same na. So this one is the same as the objective of the financial accounting. Financial accounting. So ukumbuke tulikuwa tumesema pale mbele mwanzoni the objective of the financial accounting. So it's the same. So number 1, to show the financial performance. Number 2, to show the financial position. Number 3, to show the information about the cash flow, that is money in, money out. And then stewardship, we had talked about it, to make sure that the management uses the money well, the money entrusted to them by the owners. And then the last one here, to enable decision making and comparison. So hii unaweza kando kando ukitaka. So it allows the users, so enable users of this information to make informed decision and comparison across time and across entities. Now that marks the end of the financial accounting topic 1, unless you have a question. So I'm going to share these notes. Do you have any question? Bosire. I see we have someone called Bosire. Bosire James. Hey, Bosire James, umeongea view once. Hatujataka kusikia. Okay, no worry. Now, I think that is all. What about Lucy? Do you have a question or? So remember topic 1 and topic 2 tutafanya ni theory. Hata topic 2 will be theory. So don't worry about tukishaanza hesabu mkuwe very keen kwa hesabu because isije kikawaramba. Now I think that is all. unless you have a question. So Lucy, do you have any question? Okay, no one is talking. Now I think we can. So no question. So I'm a type. So I'm going to share this in your group. So we shall meet tomorrow. So this week we are going to do financial accounting. I'm still preparing for QA and economics. We shall start maybe from next week. But for this week, up to Friday, we are going to do financial accounting so that we finish topic 1 and topic 2 theory. So that is all. I wish you a good evening.